Okay, welcome to the results of simulation round number 3. So this week you had something different to deal with, and it was this executive decision. So why were you doing this? One of the things that you've probably appreciated at university is that often when you sit exams and you get essays or assignments, there's often a right answer. What you're going to find as you get into the real world is the decisions that you face are very ambiguous, and that's why people are obviously paid good money in a lot of these corporate places, like banks, because you've got to grapple with ambiguity, and there is not necessarily a clear-cut answer. There's any number of answers that could work, and this is the challenge of working in the real world to a large extent. So, as a future-ready graduate, you go into the workforce, and if you understand that there is a lot of ambiguity, and you know how to at least think through some of these things, it's going to put you in a much better place than somebody who's always searching for just the sole right answer. Because the truth is that certainly as you enter as graduates, and even when you progress to much more senior levels, at the very top levels, the decisions that they face are definitely not black and white. And you want to be able to demonstrate some of those skills early on to show that you are in a position to move into those kinds of roles. That's where most management teams spend most of their time, dealing with things that are ambiguous that don't necessarily have a clear cut answer. So this situation said that your bank was holding financial data for a lot of customers. The issue was the customers had trusted you with this information, and you had said that you wouldn't share it. But the intelligence organization in Australia had approached you and wanted unrestricted access to the data without any oversight because they believed that they could prevent a significant amount of future terrorist activities and shut down drug operating trafficking rings if they were to get this data. But the challenge was that it was going to go against your promise to customers. So we gave you three options here. The first one was to honour the commitments and prevent access to the customers and say we're not willing to give up this data. But you're worried there that if it is ever revealed that you could have prevented the next terrorist attack, what would that look like? Maybe you'll allow the access, so you let them do this, and you're hoping that maybe by doing this, if they do prevent the next attack, people would appreciate it. However, the data policies would need to be changed, and that might impact customer trusts. And the third option was to do covert data, which is allow them to secretly access the information and just hope the customers don't find out. So we had 5 of you preventing access and 1 of you choosing to use the covert data. And really what we're thinking about in this situation, like I said, is how you actually come up with this decision, because none of these options are perfect. And I'm sure you'd appreciate that there's trade-offs around this. So I guess the takeout for you as you go into the real world is when you're dealing with these situations and there's a lot of ambiguity, you need to be able to think about the trade-offs and distill it, crystallize it in your head. So what are the impacts, short term and long term? What are the impact on our main stakeholders? Let's think about the impact on customers. What's the impact on shareholders? What's the impact on the community? Is there an impact from regulators, regulatory impact? Is there going to be a political impact? So having these sorts of things in the front of mind really helps you to distill a lot of the impacts. And then when you've understood the impacts, then when you make a decision, you're in a much more informed place. So we had those who prevented access. You're basically giving the data, and sorry, not giving the data, and it was going to mean that the customers trusted you. But as it was found out that other banks were supporting ASIO, it was also going to be difficult for you because the media would look at your bank as being uncooperative in helping to save lives. Allowing access was giving them unfettered access, but the data policy change means that customers would lose trust. And the media, however, thinks that you're doing the right thing by the community. And then covert data was, in this example here, secretly allowing them to have the unfettered access. That's actually going to be slowly leaked to the press, and customers are very upset. It also just shows your bank is being dishonest. This round of the simulation, we haven't put any impacts for this because this is a warm up for you. But next round, there will be an impact on things like your customer satisfaction, your market share, and your revenue. So really do think about some of those stakeholders as you're starting to make these ambiguous decisions. Okay, market update. This year you would have found that there wasn't very much growth at all because we were in the middle of a crisis. So home loans fell by one or grew by 1%. Business loans fell by 3. Deposits were up by 8, and credit cards, people needing their cards in this downturn time, they were up 11.5%. But what about those credit losses? So remember, you've been talking about credit losses in week 5, and you've been talking about credit risk. Losses are 8 to 30 basis points for home loans. That means for every $100 we lend out, we're losing 8 to 30 cents. That started off at 2 to 3 cents. Business loans started off at 4 to 80 cents, and now you're losing anywhere between $5 to $6.40 for every business loan you write. And credit cards started off at $2.50 for every $100 of loans that you wrote. Now they're up to $3.75. So you're going to see a lot more impairment expenses hitting your profit because of those losses. What about margins this year? Well, really good job. You actually expanded your margins this year by 1 basis point. Remember, there was a cut in the official cash rate, and your black line up the top actually fell by 5 basis points. So you only put through a little bit of this cut, but the funding cost down the bottom that actually fell in this example here by 5 as well. So small rounding perhaps leading to 1 basis point of margin increase. In terms of individual banks here, well done to Grace One, Alliance, and Virtual, all expanding their margins. A couple of the others are down. Can I just say, in the real world, this is really hard for banks to hold onto or even expand margins in a falling cash rate environment. And the reason why is because you have the lending side of things, which is your home loans and your business loans, and often there's pressure to reprice those down. But you can't actually reprice the funding costs down just as quickly because assuming that you don't raise any new wholesale funding, the benchmark rate, the bank bill swap rate, will move in line with the cash rate, so that will fall, and then therefore existing wholesale funding will become cheaper. Your deposits, you can reprice some of your deposits, but not all of them. Remember, there's interest rate insensitive liabilities, right? So you've got some transaction type deposits, and this is a big chunk of Australian banks' deposits book. You can't make those cheaper because they're already at 0%. So that means there's only a portion of your funding that you can actually save on, versus on the lending side, a lot of customers would expect all of their rates to fall. That's obviously further margin pressure in a falling cash rate environment. The same is true in a rising cash rate environment. The reverse is true actually, where those rate insensitive liabilities are a free form of funding, and as the rates rise on the lending side, you make a lot more money on those rates insensitive asset liabilities. All right, let's talk about business lending losses. This is going to come as no surprise to any of you. Big increases in losses here. This is credit losses. Some of you have tightened your lending criteria in the middle of this downturn, but just remember, because you tighten your lending in the middle of the downturn doesn't mean you automatically cleanse your business of previously originated customers. At the very beginning, in Thinking Chapter 7, there was a discussion around credit risk, and you talked about portfolio level credit risk and then individual company credit risk. So what you're seeing here is the portfolio level risk, but it's often driven in this example by some large individual losses in the business lending portfolio, which is not uncommon in the real world in a downturn. And you talked about the pricing models for different types of risks in week 5. So thinking about like that RAROC type thing, talking about the different models that you could use to really price risk appropriately. The reason why this is so important is because in the real world, you can see in this chart, this is Australian banks and their impairment losses from 1990 onwards. If you take a look at some of those periods before the big downturns, let's take a look at 2005. That's a trough period for all of these banks. And if you look at ANZ in the top left-hand corner, the blue one, their impairment expenses go from 567 million to 3.1 billion. Okay, that's a $2.6 billion increase or change over the course of a couple of years. Now, that increase is an impairment expense, and that hits their profit. That goes into their capital numbers, that erodes their capital base, and that will have a big impact on the bank if those losses were not expected. So you can see the similar thing in the COVID period where you see large increases, and this was part of the accounting rules that had changed here, where banks were now required to take forward-looking estimates of losses, and so that's what they did. And then the reverse happened when they realized the COVID situation wouldn't be as bad as they thought. Those losses were reversed, which is why you see all of the numbers in 2022 go negative. 2021, 2022, they go negative. So they've reversed those expenses. So these things have a big impact on profits for banks. They impact shareholder returns, they impact capital, and banks lose billions of dollars when these decisions are made and they turn out wrong. I know we've got some students here from obviously overseas markets. So here are some losses for the Chinese banks. Slightly different story to what you saw with the Australian banks, but again, you can see that those losses have been creeping up in the last few years. And I'm sure many of you know that there's a lot of concern right now in China about property construction companies. There's questions. You had Evergrande, you had Country Garden. So this is a big unknown for Chinese banks because when these losses get huge, it will destroy a lot of value, shareholder value. Worst thing is it'll eradicate the capital base, and then the question becomes, does the government need to step in to support these companies, or if they allow them to fail, what's the flow-on impact in the Chinese economy? All right, let's talk about bailouts this year. So there was two banks that were bailed out, Red Bank and Shenzhen Bank. So remember, you've talked about in your lectures, you've talked about the importance of liquidity and you've talked about asset liability management. When you do your treasury screen, it's really important to make sure you've got sufficient cash. And then you need to, once you've got that cash number, which should be approximately 10% of your deposits, you then need to think about where are my assets and my deposits forecast to grow, and how does that relate to what's going on in the breaking news in the market? Is my growth above or below? And then you need to look at your business settings and think, well, how am I pricing versus the competitors? And if I'm a lot cheaper than all of them based on the prior period, does that mean I'm going to get a lot more growth in the market or a lot less growth in the market? So do take a look at that because I think some teams might be struggling with this. If you look at week 1 and week 2 lectures, I put in a video there guiding you through the interface. So make sure you do look at that because, yeah, really don't want to see more bailouts year after year. Wholesale funding issues. This year, you can see some very expensive funding being raised by Shenzhen, 6.85%, Red Bank, 7.5%. Two banks not needing any funding at all, Piggy and Virtual. Those rates, I mean, if you were lending out to home loans and business lending customers using these current wholesale funding issues, you'd be writing these businesses at a loss. There'd be negative margin. So, you know, in the real world, wholesale funding markets aren't even open at times like this because investors just aren't willing to lend because they're very nervous. All right, profitability, return on equity. So some really nice profit numbers here despite the downturn. Some big losses, but good margins holding up there for GraceOne and Piggy and Virtual. Nearly $3 billion. Remember you started with $3.2 billion. Down the other end, Allianz and Shenzhen, 1.8, 1.7. So some elevated losses there and some margins eating into those two banks. All right, let's then take a look at customer satisfaction. Remember, this is 40% of your overall score. So customer satisfaction is driven by things which exceed and delight the expectations of our customers. Investments will play into a big part of this. So Shenzhen Bank in first place, Allianz in second, and Virtual Bank in third place. So well done there. Shareholder return is 60% of your overall score. Whatever banks you're building up have a forecast dividend stream, and those dividends will be calculated into the future. Piggy Bank firing away here, GraceOne in second, and Virtual in third. So putting it all together, the end of round number 3, we can see a big round of applause. Piggy Bank still in first place, Virtual in second, GraceOne closing the gap, moving up, but still in third place, but a clear third place right now. All right, there is another executive forum. So just again, remember the learnings from the last one. In your weekly submission, you might want to write a sentence on why you chose whatever it is that you chose. This year, please change the CEO again. Choose the change CEO button, find the person you want to promote, ask them to accept their promotion, and they will have all the power of being CEO. All right, round number 4 of your economic update is moving forward but carefully. So the downturn is over, but investors are still a little bit nervous. The good news is there is a little bit of positive growth now in terms of lending, and customer defaults are easing. No change to the official cash rate, and the bank bill swap rate will remain flat at 2.5%. In terms of funding costs this year, you'll be very pleased to see these have come right back down. Now, you've only got one more year left, and a lot of you are thinking, one more year left, we can increase the rates on our customers. and we can make lots of money. But just bear in mind that whatever you do to your banks at the end of year 4 will remain for a further 5 years. So, what that means is that your banks will operate for another 5 years, and that's to give you the benefits of some of your long term decisions and also to prevent any gaming. So, what that means is that after this year, all of your pricing decisions will revert back to the mean. So, price is not a sustainable competitive advantage. Your treasury will be managed optimally for you, so we'll keep you at an A credit rating. We'll make sure you have ample funding and liquidity. This is after round 4. So, you've got to make these decisions for round 4. After round 4, we'll take care of these things. Secondary levers will go back to their beginning settings. So that's the broker support levels, the lending criteria on business loans, and the rewards points on credit cards. So then how do you differentiate yourself? Well, whatever you've done to the branch network will remain with you. Some change initiatives have longer term payoff profiles, and those will continue to benefit your business momentum and will be reflected in your share price. Where you leave your bank in terms of that customer satisfaction, so non financial transformation, and the deal's done. So whoever has picked up the neobank, you now will be stuck with that neobank. All right, round number 4 will be open. So again, reach out admin@accelerateconsulting.co if you do need some assistance. All the best and speak soon.